With the monsoon now almost over, construction activity should have finally picked up, and one firm that stands to gain from that is Shankara Building Products. Joining us now is the CEO of the company, Siddharth Mundra. Siddharth, good morning. Thank you for joining us here on Bloomberg Quint. Your company was to be one of the beneficiaries of the shift under DMON and GST to the formal sector. What has the last quarter been like for you? And I'm not asking for specific numbers, but if you could give us directional moves on how you've stood to benefit from this underlying shift in the economy.
Hi, good morning. I think the last quarter, there have been certain operational challenges, post the GST implementation. June and July effectively went in a lot of the transactional issues, a lot of confusion that prevailed in the market. And generally, Q2 is a soft quarter for us. Monsoons generally dampen overall home renovation and construction activity. So I think Q2 may not give us, enough leads into how this is actually shaping up. But directionally, both these moves, demonetization and GST, should, be very beneficial for organized players like us.
So how does that change your outlook on the ongoing quarter, which is the third quarter of the year, the quarter in which construction activity picks up and in which you probably stand to gain the most, both from the formalization move and from a good quarter?
So we continue to be positive actually in terms of our overall guidance also that we have given for this year of a robust retail revenue growth. So that we continue to keep be fairly positive for the overall year as well.
Okay. You are not inclined to revise your guidance upwards given the moves in your favor or in the favor of companies like yours?
I think it's still early days, actually. I think let us deliver our performance.
Okay. Neeraj?
Interesting. Yeah. Good morning. And I just wanted to know, it's documented within notes, but just a sense of how would the next 3 years look like for your various business segments? Because unless I'm very wrong, you are on record saying as well that you want to reduce the channel sales. They obviously, while constituted a large part of your business in the past, because of the EBITDA margin accretiveness, have lost favor to retail and enterprise. How would the structure shift from what it is right now over the course of the next 3 years? And what would that do to the operational metrics and the operational picture of Shankara?
Hi, good morning. And you're right. What we are trying to is essentially rejig the overall revenue contributions of the three segments that we have. Currently, retail contributes around 50-odd% of the overall revenues. Then we have the enterprise business, which is around 30-odd%, and we have the enterprise business, which is around 20-odd%. What we intend to do over the next 3 to 5 years is to take the share of retail to almost 70%, the enterprise to stay at around the 20% levels, but the channel we would like to take it to 10% or below. What it will do to our overall margins of the company will be, even if the individual margins continue to be the same, because the share of the higher margin retail will go up. This should increase the overall EBITDA margins of the company. The retail is also the more capital efficient part of the company as compared to the channel part of the business. So hopefully the balance sheet will also become much stronger with the share of retail going up.
No, that even I'm sure of, that your margins will look much better than what they are looking right now. The only question in the minds of people is, how better can this better be?
So the retail margins that we delivered last year was around 10-odd% at the EBITDA level. We at a company level we delivered around 6.7% kind of an EBITDA margin. What we are aiming for is that for the next 3 years, these margins should possibly move up by say 50 to 100 pips. Just because of the shift of the revenue types.
Sorry, did I hear you say 300?
No, 50 to 100 bips.
60 to 100 basis points.
No, 50 to 100. 50
okay.
to 100.
Oh, fair call. Okay, I was just really positively surprised if any of the numbers could have been so large. So you're meaning 50 to 100 basis points excuse me, over the course of the next 3 years. Fair call. The other bit that happens in case of successful IPOs is that the IPO is but a first stop of fundraising, and eventually within the next 1.5 to 2 odd years, companies come out and raise for the money, the higher stock price being the higher currency. For you, it's worked out very well. Would you envisage the need to raise funds over the course of the next 12 odd months?
It's a little premature because, it's only 5 months back that we did our IPO. Having said that, there are a lot of opportunities that, we keep, seeing, which could be organic as well as inorganic. So, while our organic plans, are fairly funded, if there are inorganic opportunities that come our way, I think, a fundraise might become an interesting option to fund those. But as of now, there's nothing, that we're actively considering.
Would these inorganic plans be geography specific because you're very strong south? Would you feel the need, or do you already feel the need to expand your geographical presence within India to any other pocket which is not as dominant as south for you? I mean, west or north for that matter?
No, so our plans would largely continue to be in the south for the near term because we still feel there are a lot of white spaces in South India itself. There are certain geographies and certain product categories in which there are certain capabilities that we need to build out, and our overall efficiencies can be best leveraged if we are slightly more geographically focused at this point of time.
Okay.
So it will be largely south.
Okay. And save for the inorganic moves, you would probably do what, a 20% sales CAGR for the next 3 years, if not more?
So at the retail segment level, yes, but not possibly for the overall company.
What would those numbers be? Because when I speak to investors and their expectations from you as a consolidated entity are much higher than the numbers that you spoke about. What would be the consolidated CAGR growth numbers that you would conservatively estimate Shankara to do?
I think mid-teens is something that we should.
And this is purely organic. If you add indeed some inorganic measures, then those growth numbers would vary substantially, or would this be more a string of pearls kind of strategy that you would adopt?
Yeah, so as of now, this is all organic. So let's see what kind of inorganic